Welcome back, Grade 12 SYSC students, to this essential review explainer. Today, I am stepping into the shoes of a rigorous national accountant to help prep you for your final board certification. When we audit an economy, there is absolutely no room for guesswork. National income accounting requires strict adherence to international standards, and honestly, any deviation compromises the entire integrity of our macroeconomic data. So today, we are laser-focused on Question 8 of your syllabus, the precise precautions required when calculating national income using the expenditure method. Get ready to take some notes, because precision is our absolute passion today. Okay, let's just dive right into the definition. The expenditure method measures national income by estimating the total expenditure on final products at market prices during a given year. As candidates, you really must remember that accuracy in this calculation is paramount. We're essentially adding up all expenditures incurred by households, the business sector, the government, and the rest of the world. But we can't just indiscriminately add up every single transaction that takes place. Imagine a government making tax policies based on a wildly inflated GDP. That would be an absolute economic disaster. To prevent that, we have to follow strict rules. So here is our audit agenda for today's session. First, the overarching accounting mandate. Next, Rule 1 on imputed values. Then, Rules 2 through 5, which detail our strict exclusions. And finally, a quick audit review to lock this all in for your board exams. Section 1, the Expenditure Accounting Mandate. Let's take a look at our core principle here. Now, you might be wondering, why are we so obsessed with these rules? What are the stakes? Well, the stakes are nothing less than the accurate representation of a nation's true economic output. If we miscalculate, policymakers make terrible decisions. Read this principle carefully. Expenditure on intermediate goods is excluded to avoid double counting. Double counting is basically the cardinal sin of national accounting. It's the egregious error of counting the value of a single good multiple times as it moves through the stages of production. Our ultimate mandate is to measure only the current, final output of the economy. We must relentlessly hunt down and eliminate any transaction that artificially inflates this number. Rule 1, assigning imputed values. This is actually our single mandatory inclusion. While we spend most of our time keeping things out of the national income, there are certain non-market transactions that we absolutely must include to reflect true output. Notice the stark contrast here between obvious market transactions on the one hand and self-consumption on the other. If a farmer grows a ton of food grains and sells them at the market, well, that expenditure is easily tracked and included. But what if the farmer consumes a portion of those food grains to feed their own family? The farmer doesn't exactly ring themselves up at a cash register, but current physical production still happened. Therefore, as national accountants, we have to assign an imputed or estimated value to those self-consumed goods based on the prevailing market prices of similar products. If we don't, we're drastically undercounting the agricultural sector's actual output. And this exact same logic applies to housing. We must assign imputed values to owner-occupied housing services. If you rent an apartment, your rent payment is clearly counted as an expenditure on housing services. But if you buy a house and live in it yourself, you are still consuming a housing service every single day. You just happen to be your own landlord. Because you're enjoying housing services identical to someone paying rent, we have to estimate an imputed rent based on the market rent of similar accommodations and include that value in our final accounts. Rule 2, excluding intermediate goods. Let's shift our audit over to our strict exclusions. Notice the critical boundary here between intermediate and final goods. A final good, like a loaf of bread bought by a household, is what the economy ultimately wants. It's sold to the final user. We absolutely include this. But intermediate goods? Those are used by producers as inputs into a further stage of production. Take the flour purchased by the baker to make that bread. As auditors, we must literally exclude the baker's expenditure on that flour. Why? Because the value of that flour is already baked into the final market price of the bread. Imagine counting the flour when the baker buys it, and then counting it again when you buy the bread. You'd just be hallucinating economic growth out of thin air. Rules 3 and 4, omitting asset transfers. These two rules share the exact same underlying economic logic. This is where a lot of rookie accountants make critical errors. We're talking about transactions involving secondhand physical goods, like old cars, existing houses, or old paintings, as well as transactions involving financial assets, like the buying and selling of bonds and shares. It might seem like a lot of money is moving around when an old painting is auctioned off, or when shares change hands on the stock market, but from a strict macroeconomic perspective, spending on either of these categories is merely a transfer of asset ownership from one person to another. So, the crucial point is this. We completely exclude these transactions because they result in no addition to the economy's current output. That secondhand car was already counted in the national income the year it was originally produced. A stock purchase doesn't magically create a new factory, it just changes who owns a piece of an existing one. These transactions merely shuffle existing wealth. Seriously, remember that phrase for your exams. They merely shuffle existing wealth. They do not stimulate any new physical production in the current year, and therefore they have absolutely no place in our expenditure calculation. Rule 5. Excluding transfer payments. Our final exclusion targets government expenditure. Governments spend massive amounts of money, obviously, but as rigorous accountants, we know not all government spending is created equal. So I want to pose this direct question to you. Does government expenditure on transfer payments like old age pensions, unemployment relief, or student scholarships, does that create current physical production? Apply the framework we just discussed. If the government hands a citizen an employment check, is that citizen providing a current good or service in exchange for that money? The definitive answer is no. Because transfer payments are received without rendering any productive services in exchange during the current year, they do not stimulate current physical production. They're simply a one-way transfer of income from the government to an individual. Therefore, any expenditure on these transfer payments must be completely omitted from the expenditure method. We only count government final consumption expenditure, like spending on defense or administration, and government capital expenditure.
The final audit review. Time to check your exam readiness.
All right, our audit of the rules is now complete. It's time to consolidate this entire framework into a single exam-ready checklist. As grade 12 students, your board certification relies on your ability to recall and apply these rules without hesitation. So let's lock in our 5 definitive precautions. Number 1, you must assign and included imputed market values for self-consumed goods and owner-occupied housing. Number 2, you must strictly exclude expenditure on intermediate goods to prevent double counting. Building on that, number 3, you must omit all spending on secondhand goods. Furthermore, number 4, you must exclude all spending on financial assets like bonds and shares. And finally, number 5, you must completely exclude government expenditure on transfer payments. If you execute these 5 precautions perfectly, you will satisfy question 11 of your syllabus, which asks for the identity of output, income, and expenditure. When an economy is audited flawlessly, national product equals income generated, which perfectly equals total expenditure. Seeing these columns balance is literally the ultimate satisfaction for an accountant. If these precautions are applied with absolute rigor, our expenditure method will align flawlessly with the value added and income methods. I'll leave you with this final thought as you prepare for your exams. If a nation is sloppy, if it fails to omit asset transfers, or if it double counts intermediate goods, can its final macroeconomic accounts ever be trusted by the international community? As my future colleagues and the upcoming guardians of our economic data, I leave that question in your hands. Respect the rigor required, study these precautions, practice the calculations, and seriously, best of luck on your final board certification.